The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, the grain markets on Tuesday were pretty quiet, largely a penny higher, penny lower type of trade in row crops. Wheat found a little green. The big storyline, though, Tuesday was the bloodbath in cattle futures. Sharp losses in feeder cattle and in live cattle as well. We're going to talk about that and more. Joining us for a conversation, good to have him back with us, Jim McCormick with agmarket.net. Jim, how are you, sir? It's good to talk with you again.
Hey, good afternoon, Jesse. It's good to see you. It's been quite a while since I've been on the show. I appreciate the opportunity.
Yeah, it's been a busy summer, and good to get you back with us here on Market Talk to run through things. And, sorry I picked a quiet grain day for us, but I know we're going to talk grains in a minute. Cattle, though, oofta. Looking at this market, Jim, just felt like a really, really tough day in futures, and it looked like we set some new lows, and we got some downside risk here more, I think, as you look at the charts. I mean, walk us through, what did we see in both live cattle and feeder cattle here on Tuesday, Jim?
Well, no doubt about it, Jesse. It was a brutal day. That's just call it what it is. It was a brutal day. We've taken out some technical support. We've taken out some near-term lows. We had kind of last week was not the best signals for the cattle market. Tried to rally earlier, couldn't do it yesterday, and now we're doing some real damage. I think the problem we've got is it's been very common talk all summer long about how tight the supply is. Everyone's been mentioning it. I'm sure you've had many people on your show talking about it. Well, the problem is that has been diagnosed or dialed into the market, I would say. And now you're looking at we're about 10 days out from Labor Day weekend. We are done with your traditional kind of, summer grilling season after Labor Day weekend. So the market's really getting fearful of the demand side of the equations. The funds have been long livestock of the cattle complex for quite some time, and getting a little bit long in the tooth. And now you're getting some really nasty chart damage points, folks, that we really got to be careful about. There's two patterns that we're looking at. On the near-term patterns, you've had a hard break a few weeks back. Then we consolidated for a week, 10 days, and now we're taking out those consolidation lows. If you look at it, folks, that's a bear. That could be argued it's a bear flag, which would project another $15, $20 lower. So the chart pattern on just the nearby charts already turning ugly. But the other thing we're looking at is a long-term chart. We've been in on a weekly and monthly charts about a 4-year bull run. We are now testing those supports. And the part of the problem we're going to see is as the front month markets go off here relatively soon, the back months are trading at a discount. And Jesse, when those back months come on, it's going to show the chart breaking about a 4-year-old uptrend line. And that could be a very negative signal to the funds who say, hey, party's over. You've had a pretty good run. Move on to the next trade. And we've got to be very cautious, folks, for anybody who produces livestock out there. We know what happened to the grain market. We had some pretty good profits and all slipped away. And the cattle could do the same thing, unfortunately.
And that's, I'm glad you brought that up, Jim, because a lot of folks have been on this show and others. I know we both listen to a lot of different podcasts and radio shows and TV shows, et cetera. And a lot of folks have been talking for the last several months that, hey, at these price levels, you should look at maybe getting some hedges in place and protecting some of your downside risk here in cattle. And I look at this between Friday's sell-off and Tuesday's sell-off. I know, of course, that risk of trading futures and options can be substantial. Need to say that, but it just feels like there's got to be some. This is the time. This is the signal to, hey, get some risk management in place, isn't it, Jim?
I think you definitely need to. I mean, I know when you get these hard breaks, Jesse, I know for the producer out there, mentally it's hard. It feels like you're trying to literally do something after the fact. But I do believe there is a lot of downward exposure that could happen, a lot lower than people think. Remember, folks, the markets tend to go higher than than you think it should, and it also tends to go lower when it swings the other way. And I think one of the kind of the red flags, I think, in the livestock industry is what's happened in the stock market. The cattle market broke really hard a few weeks ago when the stock market just absolutely imploded on the yen carry trade kind of blowing up, and there was a lot of fear. Remember, Jesse, you had people out there talking recession, depression type of thing in the economy, and the stock market is in general shook that off, and we're racing right back up to it and pretty much erased that rally. So the stock market came back strong, but the livestock cattle market just did not follow suit, which I think is definitely a red flag that the market, it's not just looking at the economy, it near term. They may be getting a little bit nervous about what's going on long term. And, there is damage being done as we speak. And I think, like I said, there is risk to the downside, even after the near term sell off.
Yeah, very, very true. Well, and I know the most active October live cattle futures. We hit a 3.5 month low Tuesday. Novi feeder cattle smashing through support, hitting a new contract low as well. I mean, that's just a couple of what we saw on the board Tuesday. And you mentioned it. We're coming up on that final big grilling holiday with Labor Day in front of us here, and then with the stock market, the Fed, the Jackson Hole meeting this week. I mean, that's another talking point here we don't want to lose sight of in the broader commodity sector and the outside markets, Jim, is that, there's a lot of meeting of the minds happening this week. And what, do they say? What does that do to impact the overall market sentiment? I'm going to be watching that closely as well here, Jim.
Well, I think you got to, Jesse, because, everyone's going to key off what Chairman Powell says on Friday in his talk about what they're going to do with interest rates. The trade, I think, is pretty convinced they're going to cut rates at least a quarter point. Some people think it was a half. I think a quarter is more likely. But, we're going to key it off. I mean, a lot of the world's debt is financed in U.S. dollars. So if they will lower the interest rate, it will have a profound impact, not just in the U.S., but it'll also have an impact on other countries around the world. And that's the one thing we need right now. I mean, the reality is a two-edged sword. As you're an American, you like to see a U.S. strong dollar, especially if you want to go on vacation overseas. But the reality is a strong dollar is a hindrance to export trades for grain markets. So if the Fed starts lowering interest rates, it's not quite as attractive to own U.S. dollars. That's why, if you notice, folks, the dollar has weakening here as we've been anticipating a cut in the interest rates. And hopefully that will also sustain some more demand. Like I said, we've seen some demand, but not great. The corn demand's been okay. We are seeing China, just to kind of jump over to the grains real quick, Jesse. We're hearing reports that China bought up to 10 cargoes of beans today, which is good to see because China is way behind where they normally would be this kind of year. But I think this lowering price action combined with a cheaper dollar is finally getting some of the world's traders' attention.
You led me right to where I was going to go next, Jim. You read my mind. This demand picture is one that is curious to watch. And to your point, we have seen some of that business from China this week. Mexico bought beans as well. And I think the unfortunate thing here when it comes to corn and bean, prices and the futures board and this big drop we've seen is that, a lot of producers don't necessarily love looking at $9.75 November beans on the board or $4 D's corn. But it seems like it's starting to spur on some type of demand here, which is really what we need with expected large supplies, Jim.
Exactly. I mean, this market is not going to rally, I believe, Jesse, on a supply situation unless we have a freak derecho or maybe an early freeze at this point in time. And none of that's in the forecast. So it's going to be, to put the bottom into this market, I believe you've got to get some demand coming in and you got to get it aggressive. Like I said, the corn sales have been okay. The beans have definitely been lagging. I saw one estimate. China bought up to last week about 1 million metric tons of beans, maybe 3 million to through as a quote unquote unknown buyer. So somewhere around 4 million metric tons. Normally they're somewhere between 8 and 12. So it is very good to see them come in and buy. But part of the reason I know people are kind of disappointed. Well, China's buying. Why isn't the market rallying? Well, the reality is China's just buying what they traditionally buy the last couple months. So they're still playing catch up. And we got to be careful about this, Jesse, because I know a lot of people say, well, hey, we know that China's not buying. It's already priced into the market. I'm going to caution folks, say, no, I don't believe it is. Because when you look at the balance sheet, the government's raised exports year on year, 125, 150 million bushels. So, and I don't think the rest of the world's going to buy that many beans. It's going to be China who's going to buy those beans. So we've got to get China just to get where they normally are at before you can really get bulled up on China actually buying. But, it is definitely a step in the right direction to see these reported sales.
Very, very true. And it's one of those things where it's just been a tough conversation, Jim, for a lot of farmers when it comes to corn and beans. But, at some of these levels right now, if we can spur on some demand, seasonally, especially as we get the combines rolling as well, that could aid into a little bit of a harvest type of rally. But, to be determined on that, I guess I would say we really got to pick up this demand picture, I think, first.
Well, what you're going to look at right now, Jesse, in general, right now is the time of year. I know a lot of people are hoping for the low. We've kind of consolidated here the last couple of days. I lean to think we have not put the low in. We've still got a monster crop to harvest by all accounts. We do have the crop tour going on right now. We'll see what that plays out. The crop ratings would suggest our in-house JSA model, as well as other models, are talking, trend line yields plus for both corn and beans. So the combination of trend line plus yields more than likely, combined with a lack of farmers selling, I think fear is going to push this market down, at least near term. And then what tends to happen is we tend to bottom the market out on two things. When the market gets past that halfway done harvested, or essentially when the market gets convinced they know the size of the supply. And once they know the size of the supply, then they'll start, essentially get fixated on demand. And that's when the demand will come in. Once that demand knows, hey, we've priced all the bearishness in, then they're going to come in and hopefully get aggressive and give that traditional fall bounce or rebound. Everyone's asking, what day do you think it's going to be? That's always a dangerous game trying to pick. If I got to make a guess, it's going to be a latter part of September. I think the quarterly grain stock report, that could be as good as a day as any to look for a bottom.
We are talking with Jim McCormick from agmarket.net here today on Market Talk. And staying with the grains here, you mentioned the Midwest crop tour going on this week. And I know that is a lot of the talk on social media. Obviously, a few weeks ago, USDA gave us those big prints for quarter beans. It's something that all of this talk about the yield size, it's really kind of hammered the market psyche, so to speak, I would say, and probably will continue to do so. I'm one that it's going to come down to what those yield monitors say here as we get into the fall harvest. That's kind of my opinion, and we can get an idea here, of course, but it's when you look at all this data and just the expectations out there, Jim, I know it's a lot of talk on social media and it can play a role here, but sometimes it's, you got to get back to looking at the supply and demand picture as well as to why we've seen some of this pullback in the grain market, right?
Exactly. I mean, I think you're right. I mean, the crop tours are good. They give us a good idea where they're at. Yeah. The indexes of how we index the crop ratings to try to index yield, it's all a little bit mathematical, scientific. The reality is when the rubber hits the road is when we're getting into these fields over the next couple months, and we'll see where these yields come in at and see where the market's dialed in at. And like I said, then it's going to be a combination of, as we find the yields, to find out where does the demand come in there and get aggressive. I mean, if you look at the current balance sheet right now, the stocks used for the corn is at 13.9%. If you look historically, Jesse, from 2014 to 2019, every one of those years, corn got down near 350 to, if not low threes, every one of those years in the fall. What did they all have in common? Stocks use ended up between 12 and 15% in those years. So the stocks use argument, I believe, would still argue we've got maybe one more flush out. And if corn goes to 350, a 2.6 corn to bean ratio would argue beans down toward the low nines. So like I said, I think you got one more push down, but then hopefully we put a nice recovery in and, we'll see what happens in South America's weather later on this winter.
Yeah, we're going to quickly shift to South America here and their weather conversation, no doubt. In terms of old crop corn beans, that's a totally different conversation at this point. As we're trying to wrap that up, there's been a lot of farmers selling there of any remaining bushels. New crop though, 24, even 25 marketing. I mean, any thoughts there that producers might need to think about just in this window, even at some of these lower price levels, Jim? I mean, what are your thoughts looking out the next crop year or two here in terms of corn, beans, or wheat? Throw that in there too, Jim.
Well, let's just start for the crop we're getting ready to harvest right now. I do believe there is some downward risk. I know a lot of producers don't want to lock in futures, sub $4 futures, sub $10 beans. You might consider using like an option play, go out to like the October, which will give you a floor, for the next couple of weeks. See what plays out there. See if we get this one more flush out, but type of situation. The bushels I'm worried about right now, Jesse, are the bushels that are unpriced, but you can't store on farm. Those are the bushels I think you've really got to kind of hone in on and make a decision. What are you going to do? Are you going to market them? Are you going to pay commercial storage? And it's something you need to do the math, because some of these commercial storage charges, they will add up. Also, you have an interest on your money. Corn, because of the current interest rates, you're looking at about 3 cents a month on corn, just on interest, 7 on beans. So you might make a situation where it may be more proactive to sell some of that grain right out of the field, as bloody as it feels, and then maybe come back and use an option play to re-own it into the latter part. Because the fact of the matter is, what could change this whole dynamic as bearish as it looks today? It could be a weather market in South America. Right now, if you get on the internet, you'll see a lot of people talking about how low the Amazon River is because of the lack of rain they've had here in July and August. Now, it is the dry season, so it's not a problem. But if that rain does not start to materialize by October, this market's going to start reacting to it. So there is a very potential opportunity for this market to rebound. So I think you want to maintain ownerships. You just got to figure out, the most efficient way to do it.
Very, very true. Jim, as we kind of wrap it up here today, any final thoughts, anything you would reiterate to folks listening in here on the show today?
Well, I think I'm going to reiterate. Right now I know it's pretty pessimistic. There's no doubt about it. No one's happy seeing sub $10 corn. I know we've seen some cash grain trades as low as 8 with an 8 in front of it in the beans in the cash market. Yeah. I think unfortunately we are probably going to see some uglier days ahead of us, but there are going to provide some opportunity. If we really get down hard enough, folks, you're going to get an insurance indemnity play. Then you need to try to figure out maybe how you protect that, because if the market would break hard into October, you get an insurance indemnity and then it rallies back, you may get back some of that insurance indemnity back. So there are ways that you need to be engaged in the marketplace, even as frustrating it is. It will get brighter days. Demand will come. If there's one more point I'm going to make, Jesse, we are the cheapest grain in the world. We're the cheapest corn in the world. We're the cheapest beans in the world. So we are going to get the demand. We just got to get to that equilibrium where the end user says, that's it. The fall low's in. I'm going to buy. It's just going to take some time, I believe, till we hit that point.
Jim, I know you guys have a ton of resources and a great team available to talk with folks if they've got questions about their marketing. How can folks get more information?
Best way to go is go to agmarket.net, sign up for a free trial of research. If you like, we have a great app that helps you market grain. Sign up for that as well, but agmarket.net is where you go.
Jim McCormick, it is always good to talk with you and get some perspective, my friend. Thanks for being with us here today. We'll look forward to talking again real soon.
Thanks for having me on.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.